Good morning, Twin Cities. Welcome to Reckoning with Real Estate, a show about the American dream and building a better real estate company. I'm Paige Kale. I'm with the Real Estate Collaborative. You can find us online. Our website is therecolab.com. It's THERE as in real estate, and collab is short for collaborative. So the recolab.com. And today we are joined by one of our sponsors, Matt Berna, with TruStone Home Mortgage, an equal housing opportunity lender. And we'll start off by having Matt give an introduction of himself and TruStone Home Mortgage, and then we'll get started.
Sounds good. Thanks, Paige. Glad I could be a part of this. Glad I can be a sponsor of the show. So excited to be here. I know before the show we were talking, I really like the graphic you guys made. I think that's an awesome job. It looks really cool.
Thanks.
It's nice to be able to see it here. So yeah, I'm Matt Berna. I'm a lender. I'm with TruStone Home Mortgage. We're a division of TruStone Financial Credit Union, which is an equal housing opportunity lender. I've been with TruStone since 2021. So what is that, 4 years now?
Yep.
Goes by fast. I was in the mortgage industry for 6 years before that with a different company, which is a private mortgage insurance company named MGIC. So have a good background in the mortgage industry, in financing, of understanding how things work, how people buy homes, what goes into it, what helps people achieve the American dream. So excited to help people, excited to talk about the process, help people get a better understanding of what goes into buying a home, and making sure everyone is able to find something that works for them, achieve their goals, their dreams, and be in a good situation. So
Great. Yeah, we have worked, Rec has worked with Matt for about 2 or 3 years now. And I think one thing we appreciate about you, and of course we've worked with a lot of different lenders, and not all lenders or loan officers are treated equally or are the same. But you are just incredibly responsive. You answer your phone, you respond to emails and texts really quickly, which in this industry is huge, as you know.
Yep.
Why don't we start off with, tell us about, so TruStone is a credit union.
Correct.
And then TruStone Home Mortgage is its own entity. I've worked with some credit unions in the past, 20 some years that I've been doing this. And, because credit unions, mortgages aren't their main book of business, sometimes it can be a little sticky. So
Yep.
Talk to us about how TruStone Home Mortgage is different from like your typical credit union mortgage department.
Definitely. So we have a really unique value proposition, I think. Not position.
Proposition.
Value proposition. That's what I'm looking for.
Yeah.
Where we still have the backing of a credit union, but we operate as a mortgage company. So we have all of the spectacular products and things that go along with being a credit union. We're member first. We're actually the second largest credit union in Minnesota, which is pretty exciting. And I believe we're also the oldest chartered credit union in Minnesota too. So it's nice that we have the member base, people we can give back to, people we can help. And there's a lot of misconceptions where you need to be a member to do a loan.
Mm-hmm.
You do have to become a member during the process,
Mm-hmm.
but it's not like there's any sort of requisite to become a member. If you're interested, you want to buy a home, you could become a member. But what's unique about that is a lot of times credit unions, big banks, they really don't care as much about the member, about their clients. It's more of just a checklist, a number off. So
Yeah.
more 9 to 5, more not getting really a personal touch, understanding the client, meeting them at where they want to be met, and finding a good approach for them. So I think what's really special about us and myself is, finding solutions for customers, finding things that go outside the box, working nights, working weekends, making sure that I'm available to our clients, our members, to help them with this process, which for a lot of people is their biggest financial decision they'll make in their lives. So having the backing of being a credit union, but also having the ability to operate where we are a little bit more agile. We take advantage of things that are out there. We we want to do what's best for our members and clients. I think really helps differentiate ourselves from other banks, other credit unions in the market here.
Yeah, yeah. And we, of course, have experienced that, and our clients have experienced that working with you. A couple thoughts. One is, when the bigger companies, like the national big box companies that I won't name, but they're the ones that advertise a lot on TV and radio. And I think some people get kind of, you hear the name enough that that's their go-to, when they want to get a mortgage.
Mm-hmm.
And one thing I've noticed, and we have had clients that have worked with those companies, we never talk to the same person twice, and people get kind of shuffled around to different people. And I think that's what's really nice about just working with a local lender.
Yep.
And I know, so is it accurate to say that when you first have contact with a potential client, if they work with you, they are working with you through the entire purchase, through closing and beyond?
Correct. Yep. So I take a full service approach, and I think all of us at TruStone do, where if you work with me, you were with me the entire application process up until closing. And I still tell people after your loan closes, I'm available for questions, scenarios, anything I can help with. So even earlier today, I had someone who closed in January. And he was asking me questions about his payments. Hey, if I adjust my payment this much, you know what to do? So I was able to send this person a breakdown of showing, all right, yeah, if we do adjust your payment by an extra $18 a month, what that's going to do over the life of your loan for saving you on interest. So things like that are big things that I like to do to help differentiate myself and really service that client. It's kind of funny. I think about when I bought my first house, before I was in the mortgage industry, I didn't know what was going on. And it was like the worst experience of my entire life. I had no idea what was happening. I couldn't get a hold of anyone. Didn't know what like the numbers were. I used a down payment assistance program in Wisconsin, which was not clearly described to me or portrayed, I guess, and figure out the day of closing, all these different things, these different costs. And I was like, this is such a headache. I hate it. I had hair then. Not the reason I lost it, but it's just going through that process. Then I had the opportunity to get in the mortgage industry and like, wow, I can't believe how much better things could be. When you only do it once or every so often, you just associate like, oh, it must be this bad for everyone. And it's like, that's not the truth. Once I got into it and got to realize where I could make things my own, the level of service you can give someone and help someone, it really makes a difference. And it really showed like, that was not fun. And I don't want anyone to ever go through an experience like that when they don't need to.
Right. Well, you said that, it's one of the biggest, usually the biggest financial decision that anybody is going to make in their lifetime, purchasing a home. And you mentioned your experience when you purchased your first home. It reminded me of when I purchased my first home back in like 2001, I think, or 2000. And maybe we can talk a little bit about seller paid closing cost. I know that's kind of very specific, but to your point, I wasn't a realtor then. So I didn't know kind of how it all worked. And we were first, didn't have a lot of cash, had our down payment, but needed help with the closing costs. Yep. And so our realtor said, well, how about you should try seller paid closing costs? Let's write that into the offer. And in my mind, I thought, well, that is so nice of those sellers to pay for our closing costs. I didn't realize that really we were paying for the closing costs. They were just wrapped into our mortgage and we were paying them off over the 30 years with interest.
Yep.
So talk a little bit about just how you work with people in terms of explaining to them kind of the ins and outs, because it's a lot of numbers.
Yep.
It's a lot of moving parts. Some people have the private mortgage insurance, some people don't. So how you kind of work with people and explain things to them.
Definitely. So I think you and I have a really unique opportunity where we get to help people buy a house or sell a house many times, right? Like for a lot of people, they only do this once, twice, 3 times their entire life. So we have a good opportunity where we get to see how things work, explain things on a different level, but it also becomes more of a second knowledge to us where, we assume that people know things because we go through it so often. So I always try to take back the approach when I'm talking to clients, especially when someone who's their first house, making sure they understand the different terms we're going over, what their terms are, what their program is, what the closing costs are, understanding what an escrow account is and what goes into that. So I think a lot of times people don't realize what's out there and what they're being charged for, what the different parts of their payment are going towards. So making sure people clearly understand all the different components that go into it. And a big thing for me is being very transparent with people. So letting them know what fees are included, what sort of things they can expect, what interest rates look like. So it's a big thing for me is making sure people understand what's going into that process, what they're paying for, what the closing costs are, and making sure they feel comfortable with it, right? You think about your scenario where it's like, of course, this person's so nice, they're going to pay seller closing costs. And it wasn't told to you. It's like, all right, well, you're actually going to put that on top of your purchase price. So you're paying it back over these 30 years.
Right.
But sometimes we look at that as a strategy, right? So, but it's making sure that that person has the conversation with their lender, with their realtor to understand what that is. And if it's a situation they want to take advantage of or be in, because not everyone wants to do something like that.
Yeah. Yeah. And I think you're really good too about providing people upfront with loan estimates and, the one page with all the different numbers on it, from the breakdown of the mortgage payment, all the different closing costs. And that's a real service that I don't know that every lender does that upfront without being asked necessarily. So that's great. And then why don't we start talking just a little bit about kind of the basics of starting the process and how somebody would go about starting the process if they're thinking about buying a home and want to talk to a lender?
Of course. Yeah. I always think the best starting point is to get pre-approved. I know a lot of people are so eager. They get excited. They're like, oh, look at this house I found, or I drove by a house that looked great. And things might look really nice and it looks good, but until you sit down and establish a budget and go through pre-approval, it doesn't really make sense to look at a house, right? I mean, someone could look at a house like, this is beautiful, but if it's outside the budget of where you feel comfortable, maybe you don't want to go take your time and look at that one, right? And especially for you, if you're showing someone a house, you want to make sure that they're comfortable with that price range, with the budget, and something that's inside their means. So I think the first step is always getting pre-approved, which starts by filling out an application where the lender is going to take information on the borrower of address, income, assets they have, and there's just general legal questions that go through and ask about foreclosures, debts, lawsuits. All that information helps us put things together to see what someone can qualify for, what programs they fit into, and then figuring out what that pre-approval would look like. So for me, it's doing the application, then afterwards setting up a call with that client to kind of talk about a budget. Hey, where do you feel comfortable monthly payment wise? Where do you want to be? What's an ideal spot? Because the big thing for me isn't just finding where someone can be max pre-approved. It's more of where are you comfortable, and let's build around that for your future house.
Okay, this is a great stopping point before we go into the break, and we'll be back on the other side and we'll pick that topic up. But you are with Reckoning with Real Estate, a show about the American dream and building a better real estate company. We'll see you soon.
Breaking balls inside, bringing down the blade. Every swing you take, my heart in the fray. Crashing through.
Welcome back to Reckoning with Real Estate. We are here today with one of our sponsors, Matt Berna, with TruStone Home Mortgage, equal housing opportunity lender. I think I only needed to say that once, but there you go. I said it twice.
Doesn't hurt, right? Let everybody know.
Yeah. We were talking about at the end of the last segment, we were talking about the difference between what people are approved for and what folks are comfortable paying. And I think especially now with what's going on in the economy, with interest rates, with housing prices, I feel like it's more important than ever to have these conversations with people. I know that, well, I'm going to ask you. So what is it called? That 48% or 45%?
Debt to income?
Yes, thank you. Talk a little bit about that.
Yeah. So I think that brings up a good point, right? A lot of people, when you think about what you have to take for qualifying, we look at your credit to see where credit scores are, the assets that you have. And income is a big piece that plays into what your debt to income ratio is. So depending on what loan program you go with, there are different max debt to incomes. The most common for a conventional is a 50% max debt to income.
Sheesh.
But one thing you don't think about is the income we look at, we do gross income. So we don't take into consideration any sort of deductions that you have. Could you imagine if you used 50% of your income towards a housing payment?
No, but funny, not funny. A lot of people do pay that much for housing. And yes, it's not sustainable. And then people have to make hard choices.
Exactly. Yeah. It's crazy. And so that's one thing I like to talk to my clients with is, I think a lot of big lenders or big box places, they say, here's your max amount, and people get excited. They see a big number on paper, but they don't go through the specifics of what that monthly payment's going to look like. They get something under contract and they're like, oh my God, this is a lot more than I thought. And it's, well, I can qualify for it. I must be okay.
Right.
But that's not the right way to do things. So I think having that conversation of setting a budget with someone like, okay, if we know your monthly budget is X, that's what it looks like for a purchase price. This is what we're thinking for a down payment. This is a sweet spot of where you should be comfortable, because it doesn't make sense to spend all your money on a house, right?
No, it's called being house poor, and then you can't do other things like
just
travel or go out to eat or, have disposable income. It's all going towards your house payment.
Or like as you and I both know, if something comes up on your house, it's usually kind of expensive. If all of your money is going towards your house, you might have money to fix something that comes up. So I think establishing that budget is a really big key part of the process. And I know for me, that's a big thing I like to talk about with clients. On your side, what is that like when you kind of set a budget with clients of being a realistic spot of where they'd like to be?
Yeah, I mean, we always talk to people about you're going to be approved most likely for way more than you're going to be comfortable spending. So you need to think about, your lifestyle and what's important to you and how much realistically you want to spend on housing. The other piece that we talk about is, and you just mentioned it, is owning a house is more than just your mortgage payment. You have maintenance costs. You have utility costs, which, that can be like $150 a month pretty easily. So we do talk to people about that. Just a general rule of thumb for maintenance, just ongoing upkeep, we say like maybe $200 a month, kind of budget for that. You may not spend that every month, but
nice to be safe.
Put that aside. Yeah. And then you have the big expenses, a new roof, or you need a new appliance, or, whatever it is. So really talking to people, especially first-time buyers, about that kind of thing, that it really is your housing expense really is more than your mortgage payment.
Yep, exactly.
Yeah. One thing as you were talking too, I was thinking about, and I've experienced this with my buyers. I've also experienced it when we've had listings and we've had offers, that because housing has become so expensive, and we'll just talk specifically in the Twin Cities market, 5 years ago, I'm going to get these numbers slightly wrong, but here, let me talk about it this way. There's so many different ways to talk about it. So 5 years ago, to buy the median valued house, so this was in 2020, to buy the median valued house in the Twin Cities, you would have had to have an income of around $70,000. So a gross household income of about $70,000. Yep. Fast forward, and of course, that was the beginning of COVID. Fast forward 5 years later to today, and the median home price, I believe, is about $100,000 more than it was 5 years ago. And to afford the median housing value now, you have to have a gross household income of about $124,000. So I can't do that math in my head, but I think it's like an 80% increase.
It's huge. It's almost double in 5 years.
So how many specifically first-time home buyers that you work with are relying on their parents for some sort of assistance for the down payment?
So we actually do see that, I don't want to say all the time, but it is kind of common for first-time home buyers where you see someone where a parent is helping them out with a gift for their down payment, which helps, because a lot of people now struggle with coming up with that down payment. And people think it needs to be 20%. It doesn't. It can be as little as 3 or 3.5% down, depending on the program you go with. But still, I mean, you graduate college, you get your first job, you have student loan payments, you have a car payment, you have the rent or wherever you're living now. It is hard to get together 3-5% to save for a down payment plus closing costs. So it's very nice when people do have an opportunity that works. What also works out pretty well is we do have some programs in Minnesota. We have a phenomenal housing finance agency called Minnesota Housing, which does have options for buyers for down payment and closing cost loans. I see a lot of times people get confused with these. They think they're grants. They are not. They're not grants, but they are really good options that are eligible for eligible buyers that can fit into these programs, or it can really help them bridge the gap of what they need for a down payment closing costs to help buy a first house.
Yeah. And then there are also local programs available through cities and counties as
Correct.
well.
Yep.
Yeah. And are you connected with all of those?
Yep, we are. Most of them are eligible for every sort of lender who's out there. You just have to check. A lot of times the county and city funds go pretty quick. So it's always tough, but there's certain qualifications you need to meet. All of them are different by which county, which city you look at. So they're going to be looking at things like credit, income, to make sure you're under a certain limit to be eligible for these programs. So there's a lot of really nice programs that are out there. There's a lot of really good free resources that are available to you online that people can look at, or it's something that a lender could work with you for. So you could reach out to a lender if you're working with someone and say, hey, I'm really looking at this area. I really like this county, these cities. What other sort of programs are there? What else is eligible to help me? And someone has the ability to go and look and see, like, okay, I can see there is X amount of funds available in this housing association project, or X amount of money available in this county program. So it's nice that someone will take that extra step to find resources that help someone, overcome that big hurdle, which is the down payment and the closing costs.
Yeah. And a lot of times you can layer these programs, correct?
Yep, exactly. So you can have multiple different programs to use to buy a house, so it doesn't all need to come from just one source. You could be using one program, you could have a gift, you could have another program layered on top of it. So there's lots of multiple options that you can use to come to your advantage, as long as you fit into the eligibility for them.
Yeah. And do you have, if there are first-time buyers or people out there thinking of buying their first home, what is a typical price range? I know it depends on so many factors, income and all of that, but for a first-time buyer wanting to purchase a single family home, and of course it depends on area too, but is there like a typical price or a price range that is typical?
You're right. It definitely is very dependent on where that person wants to be and the house type, right? If someone's looking at a condo, a townhouse versus a single family home. So there's a lot of different things that go into it. But I'd say typically someone in the metro looking for their first house, they're probably looking around a purchase price of $300,000 to $350,000, which is crazy to think, right? Your first house is $350,000.
Do you remember how much your first house cost?
I do. It was $135,000.
Okay. And where was it? In Wisconsin, did you say?
St. Francis, Wisconsin. Yeah.
Okay. And mine was in St. Paul on the west side. And I think it was like just under 200,000.
I will say my house where I lived, not a bad area, not the greatest, probably only worth like 170 now, but still, in 7 years, that's a pretty big increase.
Yeah, for sure. Well, and two, people buy houses for all sorts of reasons. One of them being the equity that you can build and the wealth that you can generate. And so there's the price increase from what you purchase it for to what it sells for maybe 10 years later or whenever you sell it. But then I always think of it, your mortgage payment is almost like a piggy bank, a savings account, versus if you're renting and you're just giving the $1,000 or $1,500 or whatever it is to your landlord to pay their mortgage, you're kind of buying down the principal.
Yep.
And then when you sell, you have that chunk of money as well as the appreciation.
Exactly. And I think that's the big key to it, right? Is while that house is appreciating, and we've seen a huge rise in homes appreciate the last couple of years, you're also buying your equity position down, greater, because you're buying that principal down while it's appreciating. So it's going both ways. So then when you do sell that house in the future, you have all the money you've paid off on your loan plus the appreciation. So you think about building wealth and what a home can do. That's one of the greatest wealth builders we have in our country, is owning a home and using that to buy a new home, leverage it. You can pull money out of a house. So there's lots of different options you can do. That's one of the biggest things we've seen for people to kind of take advantage and build wealth.
Right. And it's so important. And, part of what we do at REC, at the Real Estate Collaborative, is we think a lot about, because housing is commodified, and because it is kind of this investment and this wealth generator, then there's some negative consequences and some negative effects to that. And we are running out of time now, so we will probably table that for our next show. But thank you so much for being here. And as one of our sponsors, you'll be back, and we'll talk about other mortgage related things and maybe get into some of the deeper topics like the commodification of housing. Okay, well, thank you for tuning in to Reckoning with Real Estate, and we'll see you next Sunday at 11 a.m. on AM 950, where we'll continue our conversation about the Twin Cities housing market and all things housing. And if you have any questions of us, feel free to visit our website at therecolab.com. And up in the upper right corner, there's a button that says Let's Talk, and drop a question in there, and we'll try to answer it as best we can. Have a great week, and we'll see you next weekend, next Sunday.
There we go.